Silver didn't just rally, something underneath it snapped, and the market can't stitch it back together quietly. Because the story you're being sold is silver is up because people are nervous. And that's a convenient, tidy little headline that lets everyone go back to sleep. But the move you're watching right now is not just emotion. It's structure, it's math, it's incentives, and the conflict is simple. The mainstream is glued to the spot quote like it's the whole truth, while the real pressure is showing up in the plumbing, where the people who actually have to source metal hedge exposure and survive margin calls live. And if you understand that plumbing, you'll also understand why the next 1 to 2 weeks matter more than the last 2 months. Because if one level breaks, the math changes. And I'm going to give you that level, the why now trigger, and the checklist that tells you whether this is a controlled retest or a continuation squeeze that doesn't tease, won't give you a polite entry. Here, it is the uncomfortable part for a lot of people. Silver is one of the few markets where the price can look calm on the surface while the underlying system is getting stressed. Why? Because price is an output. The system is the input. The system is futures positioning, dealer hedging, inventory categories, liquidity conditions, and the cost of being wrong. And in January 2026, silver isn't moving like a sleepy precious metal. It's moving like an asset with tightening availability and rising reflexivity, where price moves cause behavior changes, and those behavior changes feed back into price. That's the loop. That's where the real pressure starts. Let's ground this in the right now context without playing make-believe. Silver started this month around the low 70s per ounce and then ran into the 80s and 90s with a kind of speed that makes people argue on the internet. You've seen prints in the low to mid 90s recently. Depending on the exact moment you look, it's been hovering around that zone and whipping around hard. That's a big deal, not because number go up, but because the market has to reprice risk in real time. And when a market reprices risk, it doesn't do it politely. It does it with spreads widening, liquidity thinning, and weak hands getting shaken out. But that's not the part that matters. The part that matters is what those moves force participants to do. Because in a highly levered market, what matters isn't what you believe. It's what you can afford. Futures and options let you control a lot of metal exposure with a relatively small amount of capital. That's powerful until volatility spikes and the exchange says, nope, collateral up. And when collateral requirements rise, it changes who can stay in the trade. It changes how much size can sit short. It changes how quickly dealers hedge. It changes everything. And silver, more than almost any other widely traded commodity, has a history of turning margin and liquidity events into accelerants. Not always up, sometimes down first, sometimes violently down. And that's exactly why you need a map instead of a vibe. Now let's talk about the hidden detail that reframes the whole thing. The hidden detail is not a mysterious cabal. It's not a cartoon villain. It is something far more boring and far more powerful. The curve and the cost of carry. In plain English, if a commodity is abundant and financing is normal, the market usually prices later a bit higher than now because storing and financing inventory costs money. That normal shape is called contango. But when the front end of the market starts acting tight, when the now price starts getting bid relative to a little later, the S, and when you start sniffing out stress, not always a full-blown physical shortage, but a tighter than expected availability in the deliverable ecosystem. And when that happens, the curve becomes the message, even if spot looks like it's just following headlines. Here at why this matters to you as a retail investor. The curve isn't just a nerd chart. It's a behavioral machine. If the near-term contract is expensive relative to the later months, rolling a long position forward can become less painful or even beneficial, while maintaining a short position becomes more expensive and more dangerous. That means the market can quietly tilt the battlefield. It can turn shorting is easy into shorting is a slow bleed. All. And that's when shorts don't lose because they were wrong about macro. They lose because they were wrong about the carrying costs and the timing. The calendar is the catalyst. The next detail is what flips the whole setup. So let's do the mechanism in a way that actually helps you. Imagine you're a big industrial consumer, a refiner, a fabricator, or a fund that wants silver exposure. You can buy spot, you can buy futures, you can buy an ETF, you can buy options. Each route has different constraints. Physical has logistics and premiums. Futures have margin. ETFs have flows and custody dynamics. Options have gamma and dealer hedging. But they all meet in one place. Someone somewhere has to hedge. Someone has to warehouse risk. Someone has to make a market. And when price jumps and volatility spikes, those someones become cautious. They start charging more to provide liquidity. They tighten terms. They demand more collateral. And if the exchange shifts margin rules to scale with notional value, meaning the higher the price goes, the more collateral you must post, then the market becomes self-tightening for shorts at the exact moment the price is rising. That's not a moral statement. That's a mechanical statement. The market has just made it more expensive to lean against the move, and that's where the pressure starts. And you can see the fingerprints of this kind of environment in a bunch of places at once, which is why I'm not asking you to trust one argument. We're going to stack proof, because trust in markets comes from convergence. First proof, the sheer speed and persistence of the move this month. Starting around the low 70s and pushing into the 90s inside weeks is not a gentle inflation hedge. That's a repricing. Second proof, the conversation around margins is not hypothetical right now. When the exchange and clearing ecosystem starts adjusting how it sets margins for precious metals during volatile price swings, it's acknowledging a regime shift in risk. And you don't do that in a market that's fine. Third proof, flows. Silver-linked products have seen a notable shift from years of bleeding to periods of strong inflows, and when that happens, it's not just sentiment, it's a demand shock to the custodial pipeline. Someone has to source and hold metal, or at minimum, hedge metal exposure, and that pushes on the same plumbing again. Fourth proof, retail friction. When major bullion dealers have to put banners up about high demand causing processing and shipping delays, that's not a definitive signal of a global shortage, but it is an on-the-ground symptom that demand is stressing the retail channel. It's a real-world spread between paper price and actual convenience of acquisition. Fifth proof, supply chain reality. Silver supply is not a faucet, because a huge chunk of production is byproduct. You can just decide to produce more silver next quarter without a broader change in base metal mining economics. That's a lag. That's inertia. And inertia is what makes price elasticities snap. But let S slow down for a second and translate paper versus physical in a way that doesn't sound like late-night radio. The paper market, futures and derivatives, can create a lot of notional exposure quickly. That's why it exists. It's efficient for hedging and price discovery. The physical market is slower. It has logistics. It has fabrication. It has transport. It has premiums. When those two are aligned, you don't notice the difference. When they diverge, you start seeing little tells: near-term tightness, unusual spread behavior, premiums that don't collapse even after price spikes, delays, and a general reluctance of sellers to part with metal at the headline price. Again, not conspiracy. Incentives. If you're a dealer and you done till you know what your replacement cost will be next week, you widen your spreads. If you're a fabricator and your input is spiking, you hedge more aggressively. If you're a short speculator and your margin requirement just went up, you reduce risk. Those actions are not opinions. They are forced behavior. Now, let ES talk about the part that most people get wrong. Volatility is not the enemy of the thesis. Volatility is the battleground. Silver can be going exactly where the structural math suggests and still punish you emotionally so badly that you tap out at the worst possible moment. That's the dirty trick. Markets don't just move. Markets manipulate your nervous system. And in silver, that manipulation is amplified because the market is thinner than people assume and because leverage is common. You're going to see days where it rips 5% and you feel like a genius. Then you are going to see a flush that wipes out a week of gains in hours and you feel like you were foolish for even looking at it. That emotional whiplash is not random. It is a feature of a market where liquidity providers step back, where margin changes force de-risking, and where positioning becomes unstable. Your job is not to predict every wiggle. Your job is to separate trend signal from noise and to know what invalidates your setup. Because if you don't define invalidation, the market will define it for you in the form of panic. Okay, so what is the setup mechanically if the hidden detail is curve stress and risk management pressure? It is this. Silver has moved into a zone where every additional dollar higher forces more collateral, more hedging, more reconsideration of short exposure, and more urgency from anyone who needs metal now. The higher it goes, the more expensive it becomes to fight. That creates the conditions for a reflexive loop. Price rises, shorts feel pain, are some cover, price rises more. Price rises, dealers hedge options, exposure by buying futures, price rises more. Price rises, ETF inflows accelerate, custodians and market makers adjust hedges, price rises more. That loop can run until it hits a wall. Either liquidity returns and the market digests, or demand eases and the curve relaxes, or policy and macro conditions flip and the dollar-Bosser rates complex snaps the move. Those are your off-ramps, and this is why you don't marry a thesis. You date it, you watch it, you make it prove itself. Let's hit the institutional flow piece, because this is where skeptics tend to roll their eyes. ETFs don't matter. Wrong. ETFs matter because they concentrate demand and because they change the timing. If you have persistent inflows into silver-backed products, the ecosystem has to accommodate that. It's not always a one-to-one immediate physical grab, but it absolutely alters hedging and inventory decisions. It changes what dealers do with their balance sheets. It changes how easy it is to borrow metal, how comfortable lenders feel, how aggressively market makers quote tight spreads. It also changes psychology. When a market transitions from years of steady selling pressure to strong net buying, it flips the default narrative. That narrative shift can attract new capital, which is the behavioral layer on top of the structural layer. And when structural and behavioral line up, that's when moves get large. Now, the margin piece. This is where people underestimate how boring changes can create explosive outcomes. Imagine you're short silver futures because you think the rally is overextended. You're not necessarily evil, you're just expressing a view. But if the exchange or clearing model adjusts so that margins scale with notional value, then as silver rises, your required collateral rises automatically. That's like hiking the rent while you're losing money. Eventually, you hit a point where you're not deciding based on your thesis anymore. You're deciding based on your balance sheet. And when enough participants get pushed into balance sheet decisions at the same time, the market doesn't correct. It gaps. It becomes discontinuous. You get air pockets. You get forced buying. And then, ironically, you get a violent pullback when that forced buying is temporarily exhausted and the market hunts liquidity in the other direction. This is why silver is never a straight line. This is why you need two scenarios, not one. Before we go there, we have to address the supply. Because if you're going to say hidden surge and must invest, you'd better have a supply chain mechanism that isn't just vibes. Here it is. Silver production is heavily tied to the economics of other metals. A lot of silver comes as a byproduct of mining zinc, lead, copper, and other base metals. That means silver supply doesn't ramp up just because silver price is screaming. It ramps up when the broader mining complex ramps up, which is influenced by entirely different demand cycles. Add in refining constraints and the fact that new mine supply is a multi-year story, and you get low elasticity. Low elasticity plus demand spikes equals violent price adjustments. Recycling helps, but recycling also has constraints. It depends on collection, processing capacity, and the incentive to sell scrap, which can actually decrease if people decide to hold because they think prices will be higher. That's another reflexive loop. And then you layer on industrial demand, especially areas like electronics and solar, and you get a market where the marginal buyer can become urgent. Not always because the world is out of silver, but because the specific forms, locations, and timeframes of deliverable material become tight. That distinction matters because it's the deliverable margin that moves price, not the abstract total. Now, industrial demand is where you must be careful if you want trust. Because it's easy to say solar will consume everything, and it's easy to be wrong. The truth is more nuanced. Industrial demand is real, but it's not a straight line. When prices jump, manufacturers look for ways to thrift, substitute, redesign, and renegotiate. They don't just roll over, but those responses take time. You can't redesign a supply chain in a weekend. So in the short run, demand can be sticky even if longer run substitution exists. That creates a window where price can overshoot before the real world adjustments kick in. That window is exactly where we are when the calendar is forcing positioning and the financial market is doing what it does best, front-running future scarcity. So let's talk about the why now trigger, because this is the ignition. The ignition is the calendar, and the calendar has a few layers. Layer 1, month end. Funds rebalance, risk managers tighten, and liquidity can thin at the exact moment narratives are loudest. Layer 2, futures roll and delivery dynamics. As contracts approach key windows, the behavior of hedgers and speculators changes. Some roll, some stand, some flatten risk. That creates mechanical flows that are not about news. Layer 3, options positioning. You don't have to memorize Greeks to understand this. There are price zones where options exposure is concentrated, and when price moves into those zones, dealers have to hedge in ways that can reinforce the move. If you have a lot of call buying or a lot of short calls that are going in the money, hedging often means buying futures into strength. That's the reflexive piece. Layer 4, policy and geopolitical headlines. When the world feels unstable, metals catch bids. But what turns a normal bid into a surge is when that bid hits a market with constrained liquidity and rising collateral costs. That's not mysticism. That's market structure. Now, I want to pause and make a quick calculation, not to sound smart, but to keep you grounded. If silver is around the mid-90s and people are tossing around 100, that's not some fantasy moonshot. That's a single-digit percentage move. In silver terms, single-digit percentage moves can happen in a day when conditions line up. That's why the psychological war is so intense, because the distance between I'll wait for a dip and it is already gone can be a handful of trading sessions. And when you're dealing with a market that can gap, waiting can be a strategy or it can be denial, depending on your time horizon and risk plan. But that's not the part that matters. The part that matters is whether the market confirms the structural stress through spreads, through liquidity, and through how it behaves at key levels. So here are the levels that matter, framed as a map, not as fortune telling. First, the psychological magnet. 100. Big round numbers do two things. They attract momentum and they attract defenses. You'll see sellers show up there because humans love anchors. You'll also see forced buying accelerate into it if shorts are trapped or dealers are hedging. So 100 is not just a target, it's a test. Second, the current battlefield zone, roughly the low to mid 90s. This is where the market is deciding whether it can hold gains without collapsing. If price keeps accepting above the low 90s, meaning dips get bought quickly and rallies don't instantly reverse, that's constructive. Third, the first real line in the sand support, around 90. Not because it's magical, but because it's a round number that often becomes a liquidity pool. If the market loses 90 and can't reclaim it, you should assume a deeper reset is possible. Fourth, the retest zone, mid to high 80s. If you get a controlled pullback to that zone and it holds, meaning volatility spikes, but selling doesn't T-cascade, that's the kind of retest that reloads a move. Fifth, the deeper support and thesis stress zone, roughly 80. If silver breaks down into the low 80s and stays there, the urgent squeeze narrative weakens, and you should assume the market is telling you it needs time. Not dead, not over, but different. Now, why do these levels matter beyond chart aesthetics? Because they tell you who's forced to act. Above 90, and especially above the low 90s, shorts and underhedged participants feel increasing stress. Around 100, the stress can become acute. Below 90, late longs start questioning themselves and risk managers start deleveraging. Below the mid-80s, momentum funds and shorter-term traders may flip from buy dips to sell rips. That's the behavioral layer. And when behavioral layers shift, price discovery shifts. This is why levels are not magic. They are psychology mapped onto balance sheets. Now we're at the point where I need to give you the two-scenario lens because credibility demands it. Scenario 1 is the controlled pullback and retest. In this scenario, silver has run hard, volatility is elevated, and the market needs to digest. You get a sharp pullback, maybe driven by profit taking, a dollar bounce, or a margin-driven flush. It feels awful. Headlines will scream bubble popped. Social media will laugh. And then, if the structural setup is real, you'll see stabilization. You'll all see bids show up near the mid to high 80s or around 90. You'll all see selling pressure fail to accelerate. You'll see the market reclaim key levels quickly after breakdown attempts. That's a healthy retest. It's the market shaking out weak leverage and resetting positioning. It doesn't invalidate the thesis. It often strengthens it because it transfers exposure from fragile hands to stronger hands. And that's where the real pressure starts. Scenario 2 is the continuation squeeze and gap risk. In this scenario, silver doesn't give you the nice dip. It keeps grinding higher, liquidity stays thin, and the market keeps forcing de-risking. Shorts cover, dealers hedge. ETF inflows persist. Physical frictions don't ease. And price pushes into the high 90s and challenges 100. The danger in this scenario is not that you miss out. The danger is that you get emotional and chase at the exact moment the market is most likely to punish impatience with a sudden flush. Because squeezes often end with a spike and a drop. That drop does not mean the multi-week trend is over, but it can be violent enough to wreck your decision-making. In other words, the market can be bullish and still be cruel. So what do you watch to distinguish these scenarios in real time? Watch acceptance and rejection at the key zones. If silver pops above a level and then immediately falls back and can't reclaim it, that's rejection. If it dips below a level and then immediately reclaims it and holds, that's acceptance. Watch the speed of dips. In a strong tape, dips are bought fast and bounces are persistent. In a weak tape, bounces are sold quickly and dips accelerate. Watch liquidity cues. Wide bid-ask spreads, jumpy candles, and sudden gaps are signs the market is stressed. Watch margin and risk headlines. Any tightening of collateral requirements tends to amplify moves, not calm them because it forces behavior changes. Watch flow narratives. If you keep seeing evidence of sustained buying interest through funds and retail channels, that supports the idea that this is not just a one-day panic. And most importantly, watch your own behavior. Because your worst enemy in silver is not the market. It's your impulse to turn a short-term emotional reaction into a long-term financial decision. This is the viewer psychology shield, and it matters more than any chart line. Here's how volatility will try to manipulate you. First, it will give you a euphoric up day that makes you feel late, and you'll want to buy size immediately to stop the discomfort. Then it will give you a brutal down day that makes you feel stupid. You'll want to sell everything immediately to stop the discomfort. That cycle is not accidental. It is how a leveraged market transfers wealth from emotional hands to disciplined hands. Second, it will use headlines as triggers. You'll see silver crashes after a normal pullback, and you'll see silver to the moon after a normal rally. If you let headlines set your risk plan, you will become the liquidity for someone else's strategy. Third, it will tempt you into all or nothing thinking. Either you're all in or you're out. That's not investing, that's gambling dressed up in a suit. The antidote is simple. Decide your time horizon, define your invalidation, size your risk so you can survive noise, and then let the market prove itself. Now, I need to address the Invest now before it too late angle in a way that keeps trust intact. No one can promise you anything. Silver can drop hard tomorrow even if the structural thesis is correct. But there is a reason people say before it is too late, in silver specifically. Because when this market gets tight and reflexive, it can move fast enough that waiting for the perfect dip becomes a form of paralysis. The solution is not to chase blindly. The solution is to have a plan. If you're a longer-term investor, you can think in tranches and accept that you won't nail the exact bottom. If you're a shorter-term trader, you can use levels and acceptance rejection logic to avoid buying into obvious exhaustion. Either way, you're trying to avoid one thing, being forced into decisions by volatility. Because forced decisions are expensive. So let's talk about what could break this setup, because you need to know the counterpoints. One counterpoint is a macro snapback. If the dollar strengthens sharply or real rates jump, metals can get hit. Another counterpoint is demand destruction. If prices get too high too fast, industrial users can pause orders, defer, or find alternatives. Another counterpoint is a positioning reset. If the market becomes too one-sided on the long side, it becomes vulnerable to a flush. Another counterpoint is simple liquidity return. If risk appetite elsewhere changes and liquidity providers step back in with tighter spreads, the reflexive loop can cool. And finally, there's always the policy surprise risk, something that changes the risk regime overnight. None of these are reasons to ignore the bullish structure. They are reasons to stay flexible. They are reasons to separate a strong thesis from a fragile execution. Now, let's put this into a near-term roadmap for the next week or two, because that's what you actually came for. Step 1, watch how silver behaves around the low to mid-90s. If it holds above that zone with quick dip buying, that supports continuation pressure. If it loses that zone and can't reclaim it, prepare for the retest scenario. Step 2, watch 100 as a magnet and a battleground. If silver approaches it with accelerating volatility and gaps, assume squeeze dynamics are in play and manage risk accordingly. If it approaches it and stalls with repeated rejections, expect a pullback. Step 3, watch the 90 level. If 90 breaks and becomes resistance, the market is telling you the digestion will likely be deeper. If 90 holds and becomes a springboard, the market is telling you demand is still urgent. Step 4, watch the character of pullbacks. A controlled pullback that finds bids and reclaims levels is constructive. A cascading pullback that can't bounce and keeps making lower lows is a regime change. Step 5, watch the calendar. We're in a window where month-end positioning, role dynamics, and risk management adjustments can amplify moves. That doesn't tell you direction. It tells you that whatever happens can happen faster than you expect. And if you want the most practical, hidden detail checklist, here it is. Ask yourself, is this a market where holding short exposure is getting more expensive? Are collateral and volatility constraints rising? Are flows persistent? Are real-world frictions showing up? Is supply response slow? If those answers are yes, then the market is not just speculating. It's repricing. That doesn't mean it can't pull back hard. It means pullbacks can be opportunities for the trend, not proof the trend was fake, unless key invalidation levels break and stay broken. Because if this one level breaks, the math changes. Here's the part I want you to remember when your screen is flashing red or green and your brain wants certainty. Silver is a market that punishes certainty. It rewards preparation. If you're right about the big picture but wrong about execution, you can still lose money. If you're wrong about the big picture but disciplined about risk, you can survive long enough to adjust. That's the game. So don't let a bullish thesis turn into a reckless position. Don't let a scary pullback turn into a panic sale. Decide what you're actually doing here. Are you building exposure to a structural move, or are you trying to scalp volatility? Because those are different strategies, different time horizons, and different definitions of too late. And one more thing, because this is where the community part matters. In a market like this, the edge is not secret information. The edge is staying calm when everyone else gets whipped. It's having a shared language for what matters. Spreads, liquidity, margin pressure, inventory reality, and calendar triggers. So you don't get hypnotized by the loudest headline of the day. If you're the kind of investor who wants the mechanics, who wants the what breaks this level, who wants to be early without being reckless, then stick around this corner of the market with people who think the same way. Not louder, not more emotional, just sharper. Because the next couple of weeks in silver won't just test price. They'll test discipline, and that's where the real money gets made, or lost.